Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Tuesday, February 10th, 2026. The vibe wasn't panic, it was cautious. Rates dropped after a soft retail sales print, December spending was basically flat, and that instantly set up a split tape. The Dow squeezed out another record close, while the S&P 500 slipped about 0.3%, and the Nasdaq fell about 0.6%. Headline takeaway: yields down, but growth leadership still in question. And that's where today's tension really started. On the S&P 500 heatmap, it was mixed to choppy but with a definite red tilt. Key detail here: the biggest tiles weren't helping. Megacap tech and communication services leaned red or near flat, so even a small down day felt heavier than it looked. At the same time, you still saw green pockets, especially in defensives, plus a few bright single-name standouts. So no, it wasn't a washout, it was narrow participation. That heatmap rolled straight into a pretty clear money flow story. With yields falling, rate-sensitive defensives took the lead, utilities and real estate outperformed. You also saw pockets of strength in materials and in some selective industrial names. On the other side, communication services and megacap, AI-adjacent tech were the drag. This rotation didn't look like add risk, it looked like protect the book. Here's the real conflict that defined the day: flat retail spending pushed yields lower and brought back the whole Fed can ease sooner narrative. But that same data also poked at the durability of consumer demand, the economy's main engine. So you ended up with index stability without great participation quality, and a market where single-name fundamentals, earnings, guidance, funding mattered more than broad beta. Quick chatter check. Heading into the next labor and inflation prints, there's fresh talk that AI-driven productivity could be distorting measured job growth. It's not a confirmed driver, but it's in the mix. And it matters, because tomorrow's jobs data is being treated as the next pressure test for that cuts are coming rates narrative. Today's warning on tech isn't about rates, and it isn't about earnings misses, it's about AI spending finally hitting its limits. UBS downgraded U.S. tech to neutral, arguing the AI infrastructure boom that powered this bull market may be nearing a peak after tripling and then some over the past 3 years. Big tech names like Microsoft, Alphabet, Amazon, Meta, and Oracle could collectively spend up to $700 billion on CAPEX this year. Investors are starting to ask the harder question: when does that spending actually pay off? Here's the tension: slower AI-Capex might help the spenders, but it's a problem for the enablers. UBS explicitly flagged risk for data center winners like NVDA, Broadcom, and Micron, where expectations are already sky high, and software's not out of the woods either. Last week's so-called SaaS-pocalypse, sparked by AI agents threatening traditional workflows, left a mark. UBS says uncertainty around growth visibility and pricing power could linger. Yes, dip buyers showed up, DDOG popped on revenues, but that rebound was about low expectations, not restored confidence. Bottom line, this isn't the end of AI, but the market's shifting from how fast can we spend to who actually earns. And that is a much tougher trade. Alphabet GOOGL was one of the clear weights today. In a session already leaning defensive, it didn't help that Alphabet announced a $20 billion bond sale. That fed right into the market's sensitivity around AI build-out funding and CAPEX discipline. When a leadership name trades like an anchor, the whole tape feels a lot less willing to chase new highs. S&P Global, SPGI, was a clean example of today's earnings dispersion. Shares dropped nearly 10% on guidance pressure and competitive fears. On a day when the indexes weren't moving that much, a move like that tells you just how stock-specific this tape has become. And it's a reminder: when a high-quality data and indices name breaks, sentiment can ripple through the broader information services space. Spotify, SPOT, went the other direction and surged on results. And that's the point. This wasn't a clean macro day where everything moved together. This was a stock picker's tape. Even with the Nasdaq under pressure, the market still paid up for the right earnings story, just not in a way that lifted the whole growth complex. Datadog DDOG jumped and ranked as one of the strongest S&P gainers. It fit the day's pattern: selective reward for company-specific execution, even while the broader software group stayed under a cloud. And in the backdrop, the debate hasn't gone away. Visibility and pricing power are still the questions investors keep coming back to. NVIDIA, NVIDIA, finished lower, and semis in general leaned red. That mattered because yields were falling. In a normal setup, that's supposed to be friendly for growth multiples. But when NVIDIA and the chip leaders don't respond, the Nasdaq stays the weak link. With expectations still sky high across AI infrastructure, the market stayed cautious. Tesla, TSLA, was one of the bright green pockets, finishing up on the day. The move extended a multi-day recovery after that post-earnings volatility, and in a session that otherwise looked defensive, Tesla Green was a simple tell. Risk appetite wasn't gone, it was just selective. Now it's all about follow-through versus a quick fade. Looking ahead, the market's frame is tight. The next labor and inflation prints are the near-term catalysts, and tomorrow's jobs data is the immediate risk point. Traders are using it to pressure test the same debate we saw today. Does softer data validate this cuts our coming view, or does it force another reprice of duration? Either way, watch participation, especially whether leadership in big tech and AI-adjacent names actually confirms the move. Wrap it up this way: the indexes held up, but the tape got pickier. The Dow printed another record, the Nasdaq lagged, and defensives did the heavy lifting while mega-cap growth just didn't confirm. AI-Capex discipline and earnings dispersion are driving the day-to-day outcomes, and the next big checkpoint is the labor data. If leadership shows up, the mood can change. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.